This month, the rocket and satellite company SpaceX went public in the largest IPO in history. Back in May, the Nasdaq loosened a long-standing rule so that a brand new giant could join its index in weeks rather than the usual wait of several months. The standards got bent to make room for the biggest player in the room. Hi, I'm Andy Temte, and welcome to Money Lessons. Join me every Saturday morning for bite-sized lessons that are designed to improve financial literacy around the world. Today is June the 27th, 2026. Last week, we went under the hood of a trading app and found the hidden machinery beneath it, the clearinghouse and the settlement system that quietly decide what you can and cannot do. Today, I want to look at something we've leaned on in nearly every episode without fully explaining it. We say the market went up or had a rough week, but what actually is, quote-unquote, the market? Today, we will define it, see where its famous measures come from, and ask what they really tell you. Now, there's no single thing called the market. There are thousands of companies whose shares trade every day. So when somebody says the market went up, they really mean that a measure of those companies went up. That metric is called an index. And an index takes a basket of stocks and condenses their combined movement or performance into a single number. We met the very first index back in our November 1st, 2025 episode. A financial editor named Charles Dow built it in 1884, tracking a handful of companies, most of them railroads. Before Dow, there was no clean way to talk about all those stocks at once. His index let people say the market and actually mean something measurable. An index also becomes a benchmark or a yardstick to measure the performance of an investment or a portfolio against over time. Now, that first average grew into the Dow Jones Industrial Average, or the Dow for short, still one of the numbers that you hear the most often. The Dow follows just 30 large, well-known American companies. Here's its first quirk. It is built on share price. The higher a company's share price, the more its movement moves the Dow, regardless of how big the company is in total market value. So a smaller company with high-priced shares can outweigh a much larger one whose shares trade for a lower price. Price, not size, matters the most for the Dow. Now, the Dow has a second feature worth understanding, one that plants a seed that we will return to later in this series. At first, the Dow was a true average. We added up the share prices of its companies and then divided by how many companies there were in the index. But that average got distorted over time. The Dow's membership changes as companies are swapped in and out, and some companies split their shares over time, which lowers each share price without changing the company's total value. Left alone, those changes would jolt the average for reasons that have nothing to do with movements in the market. So the company that maintains the Dow divides not by the number of companies, but by a figure of its own making called the Dow divisor, and it resets it whenever a split or a swap would otherwise distort the average to keep the index comparable over time. Now, here's the part that I want you to remember. That figure, the divisor, it sits in the denominator or the bottom of the fraction. Each reset is calibrated to keep the index steady through a split or a swap, and decades of those resets have carried the divisor below 1. So its small size is a record of all that smoothing over time rather than a flaw in the measure. The reason I point this out is this. Whatever sits in the denominator of a fraction can have an outsized influence on the calculation, and that as a denominator rises or falls, the computed result falls or rises. We met this inverse relationship back in January when we learned that as interest rates rise, bond prices fall. The rate sits underneath the fraction in the denominator, pushing the price in the opposite direction. I want you to keep this inverse behavior in mind because it sits at the heart of a lot of the financial math that we'll talk about in later episodes. Now, let's introduce the S&P 500. If the Dow is the oldest measure and one of the public hears the most, the one that most professionals rely on is the S&P 500. Its roots go back to another name that we met on November 1st of 2025, Henry Varnum Poor, who built a business giving investors honest financial information. That business became Standard & Poor's, the same firm behind one of the big three credit rating agencies from our February bond episodes. In 1957, Standard & Poor's launched an index of 500 of the largest American companies, now known as the S&P 500. The S&P 500 is built on a different mechanism than the Dow. It is weighted by size, by a company's total market value, what we call its market capitalization, which is the share price multiplied by the company's total number of shares outstanding. So, on the S&P 500, the biggest companies carry the most weight. The Dow is built around share price. The S&P 500 is built around company size, and that single difference is why the two numbers can tell you slightly different stories on the same trading day. Now, there's a third name that you also hear constantly, and it's the Nasdaq. When people talk about investing in the Nasdaq, they usually mean the Nasdaq 100, or the 100 largest non-financial companies on the exchange. Like the S&P 500, it is weighted by size, but the Nasdaq leans heavily toward technology companies, and that lean matters more than at first appearance. When you put money in a fund that simply tracks an index, and we're going to dig into those funds next week, that fund must hold whatever the index holds and buy whatever it adds. No one is judging each company on its merits. The index decides and the fund follows. So when you buy a Nasdaq fund, you're not just buying, quote unquote, the market, you're buying the heavy tilt toward technology companies that sit in the index and agreeing in advance to own whatever gets added next, whether you would have chosen it or not. We are watching this play out in real time right now. This month, the rocket and satellite company SpaceX went public in the largest IPO in history. Back in May, the Nasdaq loosened a long-standing rule so that a brand new giant could join its index in weeks rather than the usual wait of several months. The result is that anyone that holds a Nasdaq 100 fund is about to own a piece of SpaceX. A piece of SpaceX. What the heck are you talking about, Andy? Not because they chose it, but because the rules were changed to let it in, and their fund must follow. Now, it's worth pausing on that. The standards got bent to make room for the biggest player in the room. The S&P 500, by contrast, held its line. Its rules require that a company show real, steady profits first, and by that test, SpaceX would not qualify. Now, the other point to note is that SpaceX is only the first big tech and space company to join here and possibly skew the Nasdaq. Two of the best-known artificial intelligence companies, Anthropic and OpenAI have both filed to go public, expected later this year. And as each of those giants arrives, the funds tracking those indices will buy in automatically, and the technology tilt will deepen even further in the Nasdaq on behalf of millions of people who never placed that bet themselves. Now, what does this mean for you? The next time you hear that the market went up, pause and ask two questions. Which market and what are we measuring? On the S&P 500, a small handful of enormous companies by market size, names like Nvidia, Apple, and Microsoft, now make up huge shares of the whole. So the market can climb on the strength of a few giants while most companies in it go nowhere. The deeper lesson is this. An index is not a fixed objective thing. It is built and maintained by a committee at a firm like S&P Dow Jones Indices or the Nasdaq, which decides which companies go in, how heavily each one counts, and when the rules change. You, the investor, get no vote in those changes. When you buy a fund that tracks an index, you simply inherit those decisions, its tilts and all. None of that makes index investing a bad idea. For most people, it remains one of the soundest ways to build wealth over time. Next week, the vehicle that most people now use to buy these indices, the exchange traded fund or the ETF. We're going to see where that automatic, behind-the-scenes buying and trading truly lives. So until next week, I wish you grace, dignity, and compassion. My name is Andy Temte, and this is Money Lessons. You can find the show on all the major streaming services as well as out on YouTube. Please like, subscribe, rate, and most importantly, share this public educational good with your friends, your family, your colleagues, and maybe a neighbor. The show is produced by Nick Temte, and we'll see you next week on Money Lessons.